Hello my friends, welcome back to my channel. Today I'll be discussing the top 3 ETFs for Singapore investors in 2026. This video is not financial advice, so remember to do your own research. The first ETF is the Vanguard FTSE All World UCITS ETF. The ticker is VWRA. VWRA covers global growth and diversification. It covers the top 3,600 companies in the whole world, and it has developed an emerging market exposure. It is Ireland domiciled, and it is a one-fund global portfolio. It is the most kiasu ETF, if you were to ask me. The next ETF is the iShares Core S&P 500 UCITS ETF. The ticker is CSPX. Another similar ETF is the State Street SPDR S&P 500 UCITS ETF. The ticker is SPYL. Both CSPX and SPYL tracks the S&P 500, and both are Ireland domiciled. They also both have low expense ratios. The last ETF is the SPDR Straits Times Index ETF. Ticker is ES3. It covers the top 30 companies on the SGX. It is Singapore domiciled, so it has 0% dividend tax. Thank you, Singapore. And you can use your SRS and CPF funds to invest in it. Why do long-term investors prefer Ireland domiciled ETFs? Ireland domiciled ETFs are VWRA, CSPX, SPYL. US domiciled ones are like VT or VOO. Why do the Ireland domiciled ETFs win? It's because their dividend withholding tax is 15% as compared to their US domiciled counterparts, which charge a dividend withholding tax of 30%. Meaning, if let's say you have $100,000 invested in an ETF with a 2% dividend rate, that means $2,000 dividends annually. If you hold this in US domiciled ETFs, it will cost you $600 annually. Whereas if you hold it in Ireland domiciled ETF, it will cost you $300 annually. So just by holding a Ireland domiciled ETF, it will save you $300 per year on a $100,000 portfolio. As your portfolio grows larger, your savings on an Ireland domiciled ETF over a US domiciled ones also grows larger. In addition, Ireland domiciled ETF do not have estate tax. So meaning, let's say if you have a $100,000 portfolio and you pass away, anything above $60,000 is going to be taxed up to 40%. It's a progressive tax. Whereas if you hold this $100,000 in Ireland domiciled ETF, there will be 0% US estate tax. Okay, now we shall discuss what is the overlap between these three ETFs. So VWRA focuses on global growth. It covers about 3,600 stocks worldwide. US equities make up roughly 62 to 65% of this fund. For CSPX, it covers the top 500 companies in US, and every single stock in CSPX is already included in VWRA. For ES3, it covers the top 30 companies on the SGX. It has 0% overlap with CSPX and about 0.4% overlap with VWRA. So what should your allocation strategy between these three ETFs be? It depends on your age, what is your investment target, what is your timeline and your horizon. And let's say if you have a very long timeline, you're investing for your kids, you want a passive approach to investing, you don't want to think and analyze as to which market is going to emerge above which market, you can go for more allocation in VWRA. VWRA is a global coverage, so you are betting on the whole world growing. If let's say you are an investor that is younger, less than 40 years old, you want to aggressively chase US market returns, then you can focus more on VWRA and CSPX. If you are older and you want to prioritize passive income over aggressive capital appreciation, then more of your portfolio should be on ES3, which has a higher local dividend payout with zero withholding tax. Okay, that's all. Thank you. Remember to like and subscribe.